Hey everybody, today is Saturday. It's the 17th of August, 2013, and this is Brian Shannon from AlphaTrends.net speaking. Hope you had a good week of trading and avoided some of the sell-off here. We're looking at the S&P 500 right now as referenced by the Exchange Traded Fund SPY, and you can see here that we were down Friday as well as a pretty good amount for this week. In fact, if we look at the numbers, we were down 2.06% in the S&P 500 and NASDAQ down 1.3%. Russell was down about 2.25%, and the IYR down here, I don't know if you see that for the week, we were down 6.5%. The IYR is a commercial real estate investment trust, and that was hit hard as bonds sold off 3.6%. If we look at the 10-year yield, you can see that we're now up to 282, and just about 3 months ago we were down at 165. So interest rates are rising, and now the market is pulling back a little bit here. S&P 500, you can see, is right on that 50-day moving average. As we often reference the 50-day moving average, the direction is still heading higher, and it's a potential level of support. I also have drawn in here the Fibonacci levels off of the June lows to the recent highs, and you can see a 38.2% retracement would bring us down just to about that 165 level. Now, this sell-off this week shouldn't have been a surprise. In fact, on Wednesday, I had posted a video on YouTube saying that, things looked a little bit sketchy here, that we have to be on the lookout for the break of this head and shoulders pattern, that looking at the 30-minute time frame as we are right now over the last month, that we had this head and shoulders pattern with this neckline at about 168.5 would break it. Now, I didn't expect we were going to gap lower. In fact, that kind of ruined the trade, that you couldn't really find a good opportunity to sell short. I don't like to sell short that first few minutes of the day, and it sold off hard from there, and again continued down towards the lows for the week. So what we're going to see next week is that this 168 to 168.5, if we get a bounce, should act as resistance. Here's our potential resistance level, and the height of the pattern from 171 down to 168. What we would do is subtract those 3 points, the height of the pattern, from the breakdown point at 168.5, and we've come real close to the downward objective in the intermediate term of 165.5. So it seems as though we're in a potential level of support. There's no signs of support right now, as again we are on Friday we closed below that volume weighted average price, and the 2-day volume weighted average price acted as resistance, and that's important because that's the average price since the market gapped lower on Thursday. So what we need to see next week is some stability before we can think about getting long again. And as far as new shorts in here, after a couple percent on the downside, one of the bigger sell-offs this year, it doesn't really make sense to get aggressive on the short side. So I think we're in a kind of wait and see, let things develop a little bit, and that's sometimes what a professional does in the market, is wait for the proper pitch to come to you. Don't force it and try to get a hit each time you're up at bat. The NASDAQ was at new highs this week, just on Tuesday, in fact, for the year and for obviously the last 10 years or so. If we look back on that monthly chart. What I was pointing out on the Wednesday video was we had the potential that from this move that we broke out on Tuesday, which failed, that we had the potential from a failed move would come a fast move. That's exactly what we had happen. I didn't expect that it would happen with a gap, and again, that kind of ruined the opportunity to trade it, but it did still provide us good warning clues to move to the sidelines and not get caught up in the emotional selling that took place over the next couple of days. So hopefully that's where you are, that you've got yourself protected, and this is what stops are for. The Russell 2000, as we know, has been the stronger market, and this one really had traced out that head and shoulders pattern, and we've been talking for weeks now about the support at the 103 to 103.5 level, and I was thinking that maybe the market would sell off down towards this level. We'd see a little bit of resistance in here and then break down, but again, we had the gap lower, so we knew to be defensive with a declining 5-day moving average. The height of this pattern here, 105.75 down to 103. Let's just call it 3 points, and the break of that 103 level, you could even say maybe 103.5, will get us down to about 102.25. And I'm sorry, the 100.25, and that's where we have, if you see the 50-day moving average at 101.15, this prior resistance in here. So I think it's likely we do continue lower and perhaps get a little panicky flush below that 100 level, and then we have this trend line which we could draw back in from mid-April. So here's potential support. That's not a place to purchase, to put in bids, or if you're short, to even maybe you cover a little bit anticipatorily, but the path of least resistance in the intermediate term right now is lower. Let's take a look at those semiconductors. They broke important support level here that we've been talking about at 38, and down through the 100-day moving average. This group, really, the bigger level of potential support remains down at about 36, so you have to be very defensive in there. Financials did get down to the level that we were thinking seemed very reasonable at that $20 level, and we came down to that. That's where we have that 50-day moving average right now, but it doesn't seem as though we will bounce right away. I think it's very reasonable that we could get down to about this 1940 level, so still a pretty decent sell-off could come from here, and we would test this longer-term trend line. So going into next week in all of these markets, you have to be very defensive. Don't be in a hurry to purchase yet. We are in a primary uptrend on the daily time frame. However, near term, we're experiencing some selling, and that's time to kind of step aside a little bit. You, of course, can do short sales that will work, but I still believe they're best suited for day trades. This IYR, the commercial real estate index, you can see we took out those June lows, and that's really not good for the market. It failed with a declining 50-day moving average, and as we often talk about, it's the direction of the 50-day moving average that's more important than one or two closes above here. A lot of people thought this is where that market had the opportunity to recover and break out. It failed, and here we are at new lows. If we look at the weekly time frame, we haven't been down to this level since mid last year, and 60 still looks reasonable. I just don't think it's time to be bottom fishing. Just because it's down a lot doesn't mean it can't keep declining. So very strong defense going into next week. Again, those bonds are selling off here. They're at new lows for the year, and you look at the weekly and the monthly time frame, we've still got room to the downside. We could call this a head and shoulders pattern with the height of it up at about 131.5, the neckline down at 132, so 10 points off of 116. We could see this, well, we've exceeded it. So the path of least resistance is lower. Don't fight the trend. And finally, let's take a look at Apple. Apple has had an incredible recovery, as we know, since the earnings that found support at the volume weighted average price from the low back in that we were talking about since this gap over here. And then we had the earnings, and the stock holds up great. We didn't see any resistance at that 200-day moving average. I would prefer for Apple that we see some pullback down into this band down here about 470 to 480, and I think it's probably coming here in the next couple weeks. So be patient, pick your entry spots. Don't be chasing things like Apple up in here, and don't be trying to pick tops in the TLT bottoms rather in TLT. Instead, you want to just be patient and wait for the market to reveal better clues before you put your money at risk.